Imagine waking up one morning to discover that your life savings have lost half their value overnight. Prices for basic goods have doubled, salaries remain stagnant, and the cost of imported products has become unaffordable. This is the terrifying reality for millions of people when a currency collapses. But what causes this sudden and dramatic loss of value? Is it economic mismanagement, global financial pressures, or something more complex? To answer this, we must first understand what gives a currency its value and how that value can be destroyed. The fragile nature of money. At its core, money is not inherently valuable. Unlike gold or silver, which have physical worth, a currency is simply a piece of paper or a digital number backed by trust. People accept money in exchange for goods and services because they believe in its stability. Governments and central banks play a crucial role in maintaining this trust by regulating the supply of money, controlling inflation, and ensuring economic stability. However, if this trust is broken, whether due to reckless government policies, economic downturns, or geopolitical instability, money can rapidly lose its value. The collapse of a currency doesn't happen randomly. It follows a pattern of economic and political failures that erode confidence over time until a tipping point is reached. Hyperinflation, when money becomes worthless. One of the most common reasons for currency collapse is hyperinflation, an uncontrollable surge in prices that makes money nearly worthless. This occurs when a government prints excessive amounts of money without corresponding economic growth. As a result, the supply of money far exceeds demand, leading to a rapid decline in its purchasing power. A classic example is Zimbabwe in the early 2000s, where hyperinflation reached astronomical levels. The government printed vast amounts of currency to finance public spending, but without economic production to support it, inflation skyrocketed. At its peak, the Zimbabwean dollar became so worthless that people were forced to carry wheelbarrows full of cash just to buy basic groceries. Eventually, the country abandoned its currency entirely and switched to using foreign currencies like the US dollar. Government debt and default, a time bomb. A nation that borrows too much money can face a sovereign debt crisis, leading to a currency collapse. When a government issues excessive debt without a clear plan to repay it, foreign investors lose confidence and pull their money out. This weakens the currency, making imports more expensive and causing inflation. Argentina is a prime example. The country has defaulted on its debt multiple times, each time causing massive devaluations of the peso. When investors refuse to lend more money, the government is left with few options, often resorting to printing more currency, which only worsens the crisis. Another famous case is Greece during the European financial crisis. When its national debt became unsustainable, the country faced a severe economic downturn. The only reason Greece's currency didn't collapse was that it was part of the Eurozone, which provided financial support. If Greece had still used the drachma, it likely would have experienced a total currency meltdown. Loss of foreign reserves, the silent killer. Most countries hold foreign currency reserves, usually in US dollars or euros, to stabilize their own currency. These reserves allow central banks to intervene in the foreign exchange market, buying back their currency to prevent extreme devaluation. However, when a country runs out of these reserves, it loses its ability to defend its currency. This was a major factor in the 1997 Asian financial crisis, where several Southeast Asian currencies collapsed due to dwindling reserves. Investors panicked and withdrew their money, leading to rapid devaluations and economic turmoil. Speculation and market attacks. Currencies are heavily traded in global financial markets, and sometimes, large investors or hedge funds launch speculative attacks against weak currencies. This occurs when traders bet against a currency, believing it will lose value, and sell large amounts of it in the market. If enough investors follow suit, the value of the currency collapses. A famous example is the British pound crisis of 1992, when billionaire investor George Soros bet against the pound and forced the UK to exit the European exchange rate mechanism. The pound devalued sharply overnight, proving how financial speculation can accelerate currency collapses. Political instability, chaos equals devaluation. Markets thrive on stability. When a country experiences political chaos, investors and businesses move their money to safer assets, causing the local currency to plummet. This instability can come from military coups, corruption scandals, government overthrows, or civil unrest. Venezuela's bolivar is a prime example. Years of economic mismanagement, corruption, and political instability led to the currency losing almost all its value. Hyperinflation in Venezuela became so severe that people resorted to using barter systems or foreign currencies like the US dollar instead. Sanctions and economic isolation. When a country faces international sanctions, it often experiences a currency collapse. Sanctions restrict trade, block access to foreign banking systems, and cut off the country from global financial markets. A prime example is Iran, which has seen multiple currency crises due to US and European sanctions. The Iranian rial has plummeted in value as sanctions have prevented the country from conducting business with major global partners. The digital threat, cryptocurrency versus traditional money. As trust in traditional currencies weakens, people sometimes turn to cryptocurrency or foreign currencies as an alternative. This further weakens the national currency as demand for it declines. Some governments, like El Salvador, have embraced cryptocurrency, while others, like China, have banned it to prevent instability. Can a currency be saved once it starts collapsing? Governments use several strategies to stop a currency from collapsing, including raising interest rates to attract foreign investors, cutting public spending to reduce deficits, seeking bailout loans from international organizations like the IMF, pegging the currency to a stronger foreign currency like the US dollar. However, these solutions are often painful and unpopular. Some countries, like Ecuador, have completely abandoned their own currency and adopted the US dollar to stabilize their economy. Lessons from past collapses. Currency collapses follow a predictable pattern of economic mismanagement, excessive debt, political instability, and external shocks. While some nations recover, others remain trapped in cycles of devaluation. Understanding these crises allows us to recognize the warning signs before they turn into full-blown financial disasters.